Realty Income is a dividend investor's favourite type of stock. Many of us hold it, and it is my largest holding that I have for an individual stock. But is it currently a buy, hold, or sell? We'll have a quick run through how does it set itself up for growth, what's its dividend looking like, and how is it looking out strategically to try and continue to grow. And if you hang around to the end, whether I think it is a buy, hold, or sell. Welcome back to the channel, and if you're new here, hi, I'm Mark of Desperately Seeking FI. Let's have a quick look at what has been going on with Realty Income over the last year to date. We are down about 10%, and what we can see in there is there was a point in time where it really did drop off, and that was at the very end of October. I actually had a limit order in, as you can see, at 46.10, and that actually kicked in, and that was nearly at the bottom. And I picked up another 25 shares of Realty Income, so I now have 150 shares of Realty Income within my portfolio. And because I'm UK based and this is buying in USD, there is an FX impact on the purchase that I've made, and that sort of throws me out by about £175. But all in all, I'm up about 6% on this at the moment, and that's paying me a dividend yield of about 5.32% per year. And when we level that out to the monthly payment, it is coming in at somewhere around the £26 per month. In the last month, things have looked slightly better, where we're up about 8%, up to about that $57 mark. Whereabouts does Realty Income, the monthly dividend payer, really manage to stand out within that real estate investment trust world? So we are looking at, they have got a really good proven track record for returns, looking at about that 13.4% compound annual since they listed in 1994. We're looking at median adjusted free from operations per share growth of about 5%, and also looking at consistently growing that dividend. And they are a dividend aristocrat and sit on the S&P 500 dividend aristocrat list. They talk about that 4.3% compound annual dividend growth rate since 94. In the last couple of years, it's probably dropped down a little bit and down closer to that 3%. They are really positioning themselves for growth. How do they weigh up against their competitors? They managed through COVID to continue to increase that dividend, which is no mean feat when you think of what was going on, particularly in the real estate world. Lots of things were closing down over that period, but they still managed to grow by 2.1%. They do have a really strong balance sheet, and their credit rating is still very favourable, with Moody's at an A3 and S&P Global at an A-. The only bit on this chart that's worrying me a little bit is in 2026, what that debt repayment is looking at. That is really peaking in that year. But if you look at the sort of term to maturity, we are looking out at about 6.6 years for that. The FFO per share is looking pretty good. We've got that historical median of about 5%, and the CAGR of that growth is looking at 5% as well. If we look at that middle graph, you will see that that is pretty constant. There aren't many peaks or troughs in that as we move through the time from 1996. Look at that average of 98.2% of occupancy levels, and that is through all of the economic cycles that we've had over the past few years. They try and protect themselves and limit their exposure to retail bankruptcies, which could really affect them and have a knock-on for the bottom line. But what they do is they try and limit the exposure to some of the areas which potentially could be exposed to economic downturns. The revisions in the guidance from the Q3 reports looking at income per share increasing slightly, AFFO per share going up by a couple of cents, and then looking at occupancy still staying in at over that 98%. How do they manage to stabilize their growth and sort of keep things moving forward? If you think of how big this company is, they've got over 13,000 properties within their portfolio, but how do they really make sure that they stay top of their game? It's down to the type of portfolio that they have. You see some of these names are really well known. Even if you are outside of the US, you will still have heard of a lot of these names, things like Dollar General, etc. They are also looking at that diversification piece. If we look at the geography that they're moving out into, they are looking at that more European UK focus. And they're also looking at figuring out where consumers may change their consumer behaviours, and it is looking at these 4 different areas that they're looking at: the non-discretionary, the low price point, service orientated, and non-retail, and looking at trying to have an overlap where clients sit within at least one of those different areas, and in some cases they may overlap into a couple. One of the problems that Realty Income does have is they can't just go hiking up their rental rates, because look at some of those companies, they would just go somewhere else. So what they need to do is look at branching out into different sectors and different industries, and we've seen that with the purchase of Bellagio over the last year, and you will see that that corresponds through to that sort of acquisition growth over the last few years, but also they are starting to branch out a little bit more into the international market as they start to saturate a little bit within the US, and you can see that in the top chart. They don't just go out and willy-nilly choose what they're going to buy. They go out and they are very selective. They do lots of research and look at their strategy and figure out what is best for them to invest into, and they go through a whole analysis of clients' financial strengths to make sure that they aren't opening themselves up to potential collapses of businesses. And that ties back to the how do they protect themselves from companies going into administration, etc. They have really branched out into the European market over the last few years, and you'll see that this growth, particularly over the last year, has been quite high. And there's just some of those household names that we in the UK will know: B&Q, Asda, Sainsbury's, Tesco. And then out into the Spanish market, you've got Carrefour. They are working quite hard to be more ESG aware, so through the environmental side of things, looking at sort of bringing in BREEAM measures into any of the buildings that they are developing, also having green lease clauses in there. On the social side, looking at human rights, employees' health and welfare and safety, and then on the governance side of things, looking at increase in female board members and the board taking more of an insight into the ESG programs and performance. This shows some of the things they've been doing, looking at LED refits, EV chargers, looking at greener procurement processes, and trying to ensure that they are offsetting as much as possible. What are analysts saying about Realty Income? Where do they think the price is going to go? They are targeting an upside of just under 4% and coming in at about that 59.45 from where we are. Yeah, that's okay if you then tie that into the fact that you're going to get about a 5% dividend. So you'd be looking at somewhere around a 9% overall growth for the stock. What do I think? I think I'm probably just going to hold at the moment where I am. I might trickle in a little bit as the dividends come in, but I won't be looking at targeting any large purchases. What do you think? Do you think it's going to go up or down or sideways, or you buy, sell or hold? This is what the different analysts are saying. You've got 6 on a buy, 5 on a hold, and obviously nobody talking about selling at the moment. There are some other companies that you could go and have a look at in the US on the REIT side of things. So you could look at WP Carey or possibly Omega Health. Why don't you go and have a quick look at this video that I did when Realty Income really was stonking, and why I went and bought in at a very nice price of $46.10. Thanks very much for watching, and I will see you in the next one. Cheers. Bye.